is somewhere mentioned over here. You can see I've circled it. That retail traders will usually punch in their stop loss below the retest area or below the resistance. So that's one which you have to remember, that retail traders, if they enter at the breakout, they will set a stop loss order. But let's rewind a bit. How did the price even reach here? Let's try to understand that. Before the breakout, one thing is very clear. This breakout was created by institutions. Now, most retail traders start their analysis after the breakout. Let's rewind and go back to the point on why and how this breakout was actually created. So when you see that at this particular point, I can make a trend line. So you can see that I can, simply join these dots and I can make a trend line. Now, usually what happens is whenever the price is breaking below the trend line, what do you think retail traders do? Just give me a yes or a no answer. Like just give me an answer in the chat box. Whenever the price, let's say this is a trend line, right? Let's say this is a trend line. And as soon as the trend line starts to break, what is the first step that a retail trader does? They start short selling the stock. They feel that the stock has broken the trend line, so the stock will fall. And that's exactly what happens. When the trend line is formed, retail traders start selling. Why? A trend line break after a resistance tap is usually looked as a sign of rejection. Because retail traders are punching in their sell orders, this is the liquidity for institutions to place their buy orders. That means if retail traders would not have sold the stock at the trend line or below the trend line, institutions would have never got the opportunity to buy. So when retail traders start selling, someone is buying those stocks or someone is buying those shares. Institutions are the people who start buying. Now, why did the institutions buy? Is because they could see that retail traders are selling 10, 20, 30,000 shares. And because they are selling, institutions can plug in their buy orders and execute their transaction. So the first point, which is point A, this is where the first leg or the first part of institutional orders were executed. Now, if you have forgotten, I told you that institutions have a large order to place. I showed you a slide where I told you institutions are dependent on retail traders, point one. Point two was institutions always execute trades in a large quantity. And point three was institutions can never execute their entire quantity in one go. So now those three rules will be applicable here. So since institutions are dependent on retail traders, that's exactly the first thing where I told you that retail traders will sell below the trend line, thinking that the prices will go down. Those sell orders give an opportunity for institutions to plug in their buy orders so that they can take this liquidity. And once that happens, institutions have divided their orders into three parts. Let's say the first part executes 70% of the orders, the other part executes 20%, and the last and the final part executes 10% of the orders. So this is the first leg, this is the second leg, this is the third leg. So this point over here is the first leg of institutional orders being executed precisely at this point. And because those orders are always going to be larger in number, meaning retail traders selling 30,000 shares at a break of a trend line, but institutions wanted to buy 70,000 shares. So since 70,000 is larger than 30,000, institutions will first take all the 30,000 shares. Because retail traders sold 30, institutions bought 30,000, prices will not move a lot. But now, when retail traders are done with their selling and institution buys another 40,000 shares, that is when the price starts to move because the demand exceeds the supply. When prices reach this point, this is where the second leg of the order starts to get executed and institutions push the price even higher. By the time the price reaches this point, which is the last and the third leg of the order, only the residual 10% of institutional orders are executed. And that is how this breakout candle is created. So now understand, the point at which retail traders were buying is the point where institutions were executing the last leg or the last part of their order. And this is the point where all retail traders are thinking, hey, this is the point where institutions are actually starting their buying. No, 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 no. Institutions are not starting their buying here. Institutions started their buying somewhere here. They are probably ending their buying over here at this point. Now, as I also said, institutions always place larger orders, right? So this 70 plus 20 plus 10 could only be a small chunk of their original order. They might want to buy more shares, but at this point, they decided to only execute 1 lakh shares. Maybe let's say they wanted to buy another 1 lakh shares maybe later, but they did not find the liquidity. So they're only executing 100, 1 lakh shares, and then they're doing nothing. Now, at the point of the breakout, which is this point, if institutions stop their buying temporarily, what if institutions stop their buying temporarily? This will mean retail traders have bought, institutions have stopped buying. If institutions stop their buying, prices will not go up. And if prices will not go up, retail traders will start seeing the price to do something like this. Price will slowly and slowly, slowly and slowly come down because there is no buying that is happening, and the prices will naturally come down. When prices naturally start to come down, some breakout buyers start to feel the pain, and slowly they will start selling small quantity to get out of their breakout trade in a loss. When some of these traders keep selling, they need a buyer, otherwise they cannot sell. How many of you agree? Retail trader ने breakout के बाद buy कर लिया, right? So retail traders bought after the breakout. Now the price is not moving up. The price starts to come down a little. When the price starts to come down a little, some retail traders panic and they are like, I want to sell. I want to get out of the trade. But for them to get out of the trade, they need a buyer. How will they find a buyer? Institutions are now not buying. They're done with their buying. Retail traders have already bought after the breakout. So there is no buyer. If there is no buyer and someone wants to sell, the prices will come even lower. Imagine you want to sell something at 100 rupees. There is no one to buy at 100. Someone is willing to buy at 98. You will have to lower down the price, right? So like this, the prices start correcting a little bit like this. I'll just make my cursor red. This is the point that I'm talking about. The prices slowly and steadily start falling down, but institutions are not selling. They're neither buying, they're not selling. Retail traders are the only people who are selling in small quantity. Because retail traders are selling here and not institutions, the volumes will be very low when the prices come down. This is very important. If institutions were the people who sold at this point, the volumes at which the selling would happen will be higher. But since retail traders are the only people who are selling small quantity, and because of that, the prices are coming down, you have to understand that there will be a point where the price will reach this area where there are all stop loss orders of retail traders waiting. All of these stop loss orders are nothing but sell orders, which is nothing but liquidity. So when the price will come to the retail stop loss area where all retail traders will be selling those 30, 40,000 shares, institutions suddenly realize that these retail traders are willing to sell 30 or 40,000 shares. We anyway wanted to buy another 1 lakh shares. Let's buy here because we are getting that liquidity. So this becomes buy side liquidity for institutions. As retail stop losses get triggered, institutions punch in their buy orders. And because retail were selling 40,000, institution wanted to buy 100K, the price after reaching here will suddenly shoot up and then continue in its original direction. But the irony is, retail traders will be thrown out, they will be kicked out because their stop losses are triggered, and then the price moves up. So what exactly happens? Something like this happens. I'm just marking this on what is the final picture. The price goes up, retail traders buy here, Retail traders were expecting the prices to go up, but the prices continuously start falling down. When the price come to an area where all the stop loss orders of retail traders are executed, every retail trader on the buyer side is out. That's exactly where institutions punch in their order, and then this big green candle, which you see over here, appears. And then retail traders start thinking, bro, I entered the right stock in the right direction at the right price, but the market took me out and then the market started moving. How many of you can now connect on what is actually happening? Give me a yes in the chat box. And that's exactly what I've written. At this point, at the breakout point, retail traders have bought in the expectation that big players have bought alongside them. But the reality is, institutions have entered long back. They entered here, they entered long back, and they're not going to buy more at higher prices. They will buy more when there is liquidity. And liquidity will be existing here when at the place where retail stop losses are, retail stop losses are existing. And ironically, you will also see the price comes back to the same area where institutions initially created their buy positions. That means the price comes back like a magnet to the same area where the move originated or started from. I've also written institutions, since institutions will not buy more and retail has already bought, there are no buyers left to push the price higher. The result, prices will not move up, but rather go down to take the liquidity. That's exactly what usually happens when institutions create a trap for retail traders. Now, I'll just move lower. Now you've understood this as well, right? So you've got a good understanding now. Now, market structure is something that you have to understand very, very deeply, and I've already given you an explanation. One more thing that you need to understand are what are very crucial liquidity areas. So this is a chart that tells you where liquidity is usually found. Liquidity, as I said, is a place where either a retail trader will execute their entry order or stop loss or target, right? Where will retail traders place their entry? At the break of the high. So there is good liquidity above every high and below every low. So, right, if a stock has created a low, retail traders would want to sell here. So there is a lot of liquidity below this low. Institutions can take this liquidity and move the price higher. Similarly, if there is a breakout point over here, this is a high, there is going to be lots of liquidity here. Prices will take those liquidity and then come back down, right? So you can see those areas. So above every high, below every low, a lot of liquidity is found, and I will show that to you in like a few moments, right? Market structure is also clear. Now let's come to the main bit, right? On what is the strategy. So now we're going to be studying the order block strategy, right? So this is the order block strategy that we're going to be discussing. And this strategy will have 5 crucial parameters or rules to follow. And all of these rules are connected to the topic that I had explained. So let's go step by step. So the first topic is displacement. You need to know what displacement is. So right now, I'm not only going to explain the strategy, but I'm also going to be telling you how to identify these different concepts. So one by one, I will explain concepts. Then I will show you the schematic, and then we will move on to the charts and see how it has performed and how it has worked. And then we will go to case studies. So the first topic is displacement. Second is rebalance. Third is volume dry up. Fourth is marking the order block or the POI. POI is point of our interest. And last but not least, position sizing, placement of stop loss, and placements of target, right? So let's start with displacement first. So displacement, also known as imbalance, is nothing but a way to understand the first footprint of the institutions, right? So a displacement essentially is nothing but the idea of the stock to break the previous high. So I'll just remove this for now. So the idea of a displacement is nothing but whenever the price breaks the previous high. So I am currently talking about a bullish displacement, right? So bullish displacement is when the price creates or breaks the previous high, and it breaks the previous high with either a big green candle like this, or two big body green candles like this, or a mix of green and red candles, but the candle size should be big body. Now, why big body? Big body candles or candles with larger sizes are usually created when there is a sudden increase in buying, or if there is a sudden pump of demand or supply. That's the reason when the price moves up very quickly. Now, retail or institutions, there are two kinds of people who trade. For obvious reasons, whenever institutions punch in their trades, they are the people who trade with higher quantity, they are the people who trade with a higher size. So in all probabilities, whenever an imbalance is created, or whenever there is a big displacement candle is created, or whenever there is a big body green or a red candle is created, in all probabilities they are institutions. Now, how do we confirm if there are institutions involved or not? If the stock is breaking the previous high, it is creating a new higher high. Now, I explained market structure in the starting, that if there is a high and then there is a higher high being created, that means we are in an uptrend. Trends are created by whom? Institutions. So that's the reason the previous high has to break. This previous high has to break with a big body displacement candle. Now, why do we call it a displacement candle? The word displacement means a sudden or a quick movement, right? And this displacement is caused because of imbalance of demand over supply. Demand is very high, supply is very low, and that's why this big displacement is occurring. So, for you to identify a bullish displacement, you need the stock to break its previous high. You need the stock to break the previous high either with one big green candle, maybe two decent sized green candles, or maybe multiple red and green candles but bigger body candles. And the last condition over here is all of these candles should have been formed with high volume. Volume accompanying these displacement candles should be on the higher side. Now, again, very simple reason on why we need higher volumes. Institutions always trade and buy and sell in big quantity. So if they're buying and selling in big quantity, the volumes will be on the higher side, and hence we need volume on the higher side to for us to confirm this as a displacement. Now, once we identify the displacement, we are not going to buy after the breakout over here, over here, or over here. No, 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 no. We are not going to buy the breakout. We are only going to identify that in this stock or in this index or in this crypto or in this instrument, institutions are involved. So we have now at this point only identified one thing, that institutions are involved in this stock. Where will we buy? When will we enter? All of this is not clear yet. We have just identified that, okay, there is a displacement, there is an imbalance, institutions are involved. Now I need to find out where have they bought, at what price range will they be looking to buy, etc. So that's when we move to the second concept, which is called a rebalance. Now, what is a rebalance? Like an imbalance, when the demand is very high as compared to supply, there is a big imbalance of demand over supply that takes place. This imbalance of demand over supply will end at point B, where institutions stop buying, because from point A to point B, so this is your point A, from point A to point B, who took the price? Institutions. When they make the price go to point B, their buying is done. So they will not be buying anymore. And at point B, any retail trader who has bought the breakout will see that the prices are not moving up, and slowly the prices will come down. And as I had mentioned in the other example, that if the price is coming from point B back to point C with low volume, which is also known as volume dry up, that means the price should come down with declining volumes. This is a perfect confirmation that the price is not coming down because of selling pressure. The price is actually coming down because of lack of buyers. Now, I'll just revise this once again. I told you at point B, retail traders have already bought the breakout. Institutions have already moved the price from point A to point B. So at point B, you have neither institutions buying, neither retail buying. So at point B, there is a lack of buyers. And at point B, retail traders who entered at higher prices are slowly going to start selling. Because they want to sell, they will need to find a buyer. Buyers are not available, so there is a lack of buyer. Where are the buyers available? Buyers are available at a point where retail traders have uh, placed their stop losses, which is a liquidity area. So when the price comes from point B to point C with a low volume or a volume dry up, this B to C area is called the area of a rebalance, that the imbalance that was initially created is now getting rebalanced. It's another word for a correction, profit booking, or a pullback, right? It's just a more advanced version of judging that a correction or a pullback is healthy or unhealthy, right? A healthy pullback or a correction is when the price is coming down with not a lot of selling pressure, right? So when the price comes down to point C, the price will eventually land up in some region where institutions created this A to B wala move. That means if institutions started their move from point A to point B, they would have probably entered majority of their positions in some area which I am drawing over here. This area is called your order block. But what is this area? I'm yet to explain that. But this is the area around which institutions would have created their first initial buy orders. So once the rebalance is done, we need to just confirm that is the rebalance done with a volume dry up or not. So this volume dry up is very important. Number three is where the point at which we will be buying. So now when the price moves from A to B, and now we are waiting for the price to do its rebalance, we will create a order block, or we will mark or plot an order block. And if the rebalance ends at this point and gives us a green or a red candle closing, that is the point where we will execute our trades. So what is that point? It's very simple to mark. The body of the last red candle, the body of the last red candle before the big displacement, okay, before the big displacement is your order block. So you can see the body of the last red candle before the big displacement is your order block. Now, if there is any wick or a tail, anything of that sort, you can mark that also as your order block. And as soon as the price comes back into this range, this is exactly where you have to buy. Now, why are you buying here? You are buying here because this is probably the entire region in which institutions kept on buying. Now, I will never know the exact price at which institutions have bought, but I can know a range in which institutions created their buy positions. So, for example, I may not know that this is the exact price at which institutions bought, or maybe there is this price at which institutions bought. I don't know. All I know is that in all probabilities, institutions have bought in this range. So what will I do? Once I identify the displacement, I will mark my order block, wait for the price to come back, rebalance with a low volume dry up into my order block. And as soon as I get my candle confirmation, I will go long, placing my stop loss below the order block and a 1 is to 2 or a 1 is to 3 target, right? Now, this is way number one. This is the first way to identify an order block, body of the last red candle before the big displacement. And the other way to identify the order block is a narrow range consolidation. So sometimes you may not have a very clean body of the last red candle before the big displacement, but you may find very narrow, small range contraction kind of a structure. If that happens, this entire contraction, this entire narrow range activity will be considered as your order block. So at this point, A, when you see that the price has created a displacement candle, your next step will be to mark your order block. You can mark it OB plus, meaning a bullish order block. Now set up an alert over here that whenever the price comes here, you get alerted so that you don't have to watch the stock all day. The stock comes slowly and steadily, and when your alert gets triggered, all you need to check is whether this rebalance happened with volume dry up or not. If it happened with volume dry up, you have your confirmation. If it did not happen with the volume dry up, the trade would be a little bit on the riskier side. Similarly, you can do the same thing on the bearish side, the body of the last green candle before the big displacement. Okay, so that's your green candle, the body of the last green candle before the big displacement. For the displacement on the bearish side, now we need the displacement candle to break the previous low. Once the previous low is broken and the displacement has happened, we will mark the body of the last green candle. And now we will wait for the price to come here, tap into the order block, and as soon as it does, we will go short with the stop loss above the order block and the target at 1 is to 2, 1 is to 3, or a 1 is to 2.5. Now, important thing to remember, even when there is a correction like this on the upside, we will still need volume dry up as our confirmation. So remember that, right? So now what are all those steps? Let's quickly jump into that. First step, identify a displacement. A bullish displacement is a displacement where the previous high is being broken with good volume, with a good imbalance candle. And this imbalance candle could be one single big green candle, maybe multiple green candles like this, maybe a candle, maybe an inside candle, and then maybe a larger candle, and then maybe a larger candle as well, right? It could be in any shape or size. That's how you identify your previous high or displacement. The body of the last red candle before the big displacement is your order block. Let the price come here, then execute it. And similarly, for a bearish order block, you need to do the exact opposite. So what you need to do is you need to wait for the previous low to be broken. If the previous low is broken with a big candle, with big volume, and you mark the body of the last green candle as your order block, wait for the price to pull back into this range. As soon as you get a reaction, that's your stop loss. Your target is 1 is to 2, 1 is to 2.5, and then you can continue your journey forward. So the idea is very simple. We are not buying at any random place. We are first confirming whether this particular move was institutional in nature or not, number one. Number two, we are then identifying potential range in which institutions would have executed their order. Number three, we are then confirming whether the way in which the price is approaching the order block, whether it is retail or institutional in nature. If it is retail selling, that means this selling does not have a lot of power. And for us to confirm that, we would want a volume dry up, meaning declining volume as the prices are coming down, right? Once we have that, we take the trade on the order block, set the stop loss below the order block, and the targets at 1 is to 2, 1 is to 3. Now that all of this is clear, let me move you to a few examples here and there, and then I'll give you like a good idea. So I will initially start with stocks, and then I will move. So I will show you silver, I'll show you Nifty, I will show you Bank Nifty, I'll show you all of that. So first I will start with stocks, and then I will move to the index, I will move to commodities, I will even move to crypto, and then I will also try to cover real life case studies of where I have executed all of those trades. So now let's get started with examples for stocks first. Before I start, the time frame on which you have to do this is the 1 day time frame if you are a swing trader. Okay, so if you're a swing trader, the 1 day time frame. 15-minute time frame if you are a intraday swing trader, meaning you don't scalp, but you take like a 60 to 90-minute kind of a trade on an intraday basis. 5-minute or 1 minute time frame if you are a scalping intraday kind of a trader, right? So this strategy works across the markets, across any time frame. All you need to do is just check and cross verify if all the rules are being followed or not. With that being said, now since we have discussed the time frames as well, now let's move to examples of stocks, indices, commodities, and cryptocurrencies. So now let's start with examples. So the first example that I would take is Godfrey Phillips. The time frame is 1 day, right? Now I'll tell you why with stocks the 1 day time frame will fit in the best. Although you can use it for intraday also, and you can also use it for like a 15-minute or a 1 hour time frame. My personal favorite is a 1 day time frame, and I'll tell you why. No matter how much intraday trading you do here and there, the returns that you compare it with swing trading, especially with equity, right? If you're trading options or futures, yes, intraday is like a very good idea, right? But if you're trading equity, 1 day time frame is a really good idea in trending markets. If the markets are not trending, if the markets are only giving, maybe choppy moves, or maybe if the market is not clearly trending, then intraday works. So I'll give you some examples on the daily time frame, then I'll shift to other time frames. So you look at Godfrey Phillips, and let's try to understand step by step every single rule. Now, one thing to observe, you can see that the volume bars on my screen, right? The volume bars on my screen are actually gray in color. Now, what does that mean? This means that I don't really care if the volume bar is red or green in color, because I already know that for every buyer there needs to be a seller. So the volume color doesn't really matter. Only the intensity, or the length of the volume bar is what matters. So over here, the first thing that I can see is over here. So there is an order block over here, which you can see that the previous high is being broken over here, right? So you can see one previous high is being broken over here, and then there's another previous high being broken over here. So let's consider this first, and then I'll come to this. So the first previous high over here, so I'll just basically mark this. So when the first previous high got broken, I'll just zoom in a little bit. The first previous high got broken over here. The body of the last red candle before the big displacement is my order block. I will extend this area, right? And I'll just color this area maybe orange, just so that you can understand that this is the area that I plotted. Then what I need to do is, once I've plotted this area, so when will I plot this area? I will plot this area as soon. Okay. So people who are texting me in the chat box, I can't see the chart. I am purposely only showing you the chart that you will actually see when you will be trading live. So when, let's say today is the day when you're trading it live, right? You will only be able to see this candle. So once this candle is created, you can plot your order block. Give me a yes if you can do that. So the first check that you had to do is the previous high had to be broken. That is done. The second check was that this should have happened with the displacement long big body candle. That is also done. The third check was that this candle should have good volumes, and you can see that the volumes are just crazy and insane. And the fourth check is that when the price comes back, it comes back with low volume. So you can see the price comes back here, and it comes down with declining volume. So you can clearly see that there is a simple volume dry up that has been happening with declining volumes, which suggests that there is no institutional selling. Now, what are you going to do? You're going to execute your trade right here when the candle closes. Your stop loss, I'm just going to zoom in a little bit, right? So I'm just going to zoom in a little bit. Your stop loss is going to be below the order block, and your target is going to be a 1:3. So I'll just randomly put up the target for here. Now, once you took the trade, and this is exactly the reality of trading, right? So as soon as you took the trade, the next day the price goes down. Now, what will most traders do? Oh my God, I'm having a loss. Oh my God, I will exit. Trading is bad, blah, 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 blah. The next day, the price stays over here, and the other day, the price makes a big move, but it gets rejected. Now what will retail traders do? Oh, there is a hammer, inverted hammer kind of a candle, and price is getting rejected from resistance or supply. They will create all sorts of these things in their mind, and what you will eventually see is that then the price stays very, very flat for a decent period of time, and it's very, very close to your stop loss. And the reason I'm telling this to you is, this is the power of a system, right? So yes, the price did try to go up, but the next 7 days the stock has not given you any return. It's very close to your stop loss, but still hasn't hit your stop loss, right? The reason I'm giving this example to you is, I don't want to show you picture perfect examples always, that price came here and it just rocketed past up. A lot of times this will happen. How many of you agree? Give me a yes or no. I'm trying to show you the realistic style of trading. So you may have entered on this day, waited for about 14 days, and there was no movement at all. And then the price suddenly takes off, and it takes off in a way that will blow your mind. After those 14 days of flat action, the price moved up by approximately 68%, in the next 30 days. So overall, your trade duration was about 40 days and you captured a 80% move. Now, if you trade intraday for the next 40 days, can you get a 80% ROI on your capital? Give me a yes or a no. Not possible. Absolutely. Why? So many transaction charges, buying, selling here and there, psychology getting displaced. And then the price just makes a crazy move altogether. Like, what a move. And it did not stop here. It actually made a high over here. So if I consider the high, the stock actually doubled up. It's 97% move in a matter of about 56 days from your entry. So 2 months, 100% move. 100% ROI on your capital. Obviously, you will not be able to capture this entire move. Maybe you take a 1:2 or a 1:3, or maybe a 1:4. And when you do that, your entire trade duration was almost, let me just count it. This is your day of the entry. This is the day of your exit. About 1 month of a holding period of about 29 calendar days, 20 trading days, because Saturday, Sundays are not trading days. So 20 bars or 20 candles, 40% move. That's the power. Now, since this move was created, we got another displacement. So now you see that the last previous high was also broken. So this is the displacement candle. This displacement candle, again following the same rules, had a big volume, broke the previous high, is a big body candle. Now, if I remove this, now your order block is the body of the last red candle before the big displacement. And now, as I told you, if you do not have a clearly identifiable last red body candle, you can just mark the entire range as your order block. So this entire range will be your order block, right? So that's how basically I would mark. If you want, I can actually just recreate the process. This is your order block, and now you will extend it. Now, what will you do? As I said, you will set up an alert in this area. And as soon as the price arrives and gives you a closing, that is when you will take the trade. So now what happens? The price comes here and it gives you a closing right over here, right? So now, since you will see this, you're going to take an entry, you're going to follow the same process. You're going to basically place your stop losses below the order block, and your targets will be either a 1:3 or a 1:4, or you can also use the concept of liquidity to set your targets. Now, what did I say? Where is liquidity? Above a swing high and below a swing low. So this is a swing high. Most retail traders would want to take the breakout trade over here. Our objective is to sell when retail traders buy. So this could be a good target. Now, as soon as you enter, you can see that when the price came down all the way from the top, you can clearly see that there is a volume dry up that has happened all throughout. That was the last check that we had to make. And when the prices came here, again for the next about 6 days or maybe 5 days, the price went a little sideways, right? So you entered on this day, and then for the next maybe 9 days, stock was only down 1%. But then the stock took charge, and then it again created this massive move. And just look at the liquidity point. This is the point where liquidity was lying. This is exactly where other retail traders got trapped and you got your exit. And now this is a 83% move in 26 days. The price comes back. While the price comes back, you have got another order block. So I'll just write the previous high. Another displacement with big volume. Price comes back with a dry up of volume. Body of the last red candle. Price comes up here, and price gives you a green candle closing here. So this is exactly where you'll take your entry. Your stop loss is here. Now, where will be your target? Your target will be above this liquidity. So that's your target, right? Above this high. And then you see that the price is almost on the path or on the track to, hit your target. So how many of you understood? This is a very simple example. This is not a picture perfect example, because this is an example where I was trying to show you the reality that you'll have to maybe wait for some of the other days. Now, some people are saying, will we have to wait for 5 days for stock not doing? See, if you have a very short term approach in your trading, you will have average results like all other traders. Most intraday traders fail, right? Intraday trading, you should be doing when you've got some experience. If your objective is to make money, try to ace the simplest things first and then get into complex things, right? Now, let me take another example. Let's say Bharat Dynamics, right? I'll take Bharat Dynamics as an example and I will show you the same structure, right? So now you can see this is a very clearly identifiable order block. So you see the previous high being broken. So I'll just write PH. The previous high is being broken. Previous high is being broken with the displacement candle with good volume, body of the last red candle before the big displacement. All of this is fine. When the price comes here, gives me a green candle. While the price comes here, there is a volume dry up. Everything is good. I'm going to create a long position over here. So I'm just going to create a long position. That's my long. My stop loss is going to be below this. My target is going to be a 1 is to 3, 1 is to 4. Price actually goes down for the next 3 days or maybe 5 days, and then what the hell? Just look at this move. This stock moved up approximately 80% in 20 days, approximately an 80% move. Give me a fire or a big bull in the chat if you're understanding how this works. You have to understand that you are entering near the price range in which institutions bought. So your buying price and the buying price of the institutions is more or less going to be the same. You have to wait for institutions to act. Now, you can't really time the market that when you enter, only then the next day the move should start coming in. The move will come when institutions want that move to come. So you wait for 4 days, you get rewarded for your patience, and then the next few days of the move is just crazy and insane. Then, while this big move was being created, you can clearly observe that there was another displacement. So there's another previous high displacement that took place. This is the narrow range consolidation, which is your newer order block. And when the price comes back down to this entire area, let's see. Okay, now the price has come over here. Green candle close. Okay, here it is. I've got my green candle close. Now, while the price has approached my order block, I have a volume dry up or a decline. I'm the only person on the planet who will say buy when the volumes are the lowest. Every single other person on the planet will say buy when the volumes are higher. I will tell you buy when the volumes dry up completely, because that's the point where retail traders are out of the equation. So as soon as the price comes here, you get an entry point. Good for you. So you got an entry point over here. Your stop loss is here, and your targets could be above this particular high, which is liquidity, because that's where the next breakout is going to happen. That's your target, and you see this is a complete show. So almost your target was done over here. Like even at this point, you got a 1 is to 2.8, a 30% move in uh about 27 days, right? So that's also good enough. Now I'll show you EPAC durable. This is also a very good example, so let's just quickly jump into it. So that's your displacement. Your previous high got broken. This is the consolidation, the narrow range small body consolidation before the big move. You've got your big move. Just set up an alert, wait for the price to come here. So now someone is asking, will we wait for so many days for the trade to come? See, you've got 2,500 odd stocks, right? Pick up the top 800 stocks of India, right? By market capitalization. I will give you that list. Mark your order blocks, set up your alerts. How do you do that? Just click on this plus icon over here, alert on this particular stock. As soon as the price comes in here, your system will automatically alert you. You don't really need to watch charts all day. You will get an alert, open the chart, see if everything is happening, take your trade. That's how smart traders do things, and that's how you leverage technology to do it. Now, the price comes right here, gives me a green candle closing. While the price is coming here, I can see a volume dry up. Everything is fine for me. I've taken my entry. My stop loss is here. My target is above this high. And then boom, in less than 28 days, I've got a 70% move. I'm not even kidding. Just look at this, right? So this is like a, 70% odd move that has come up in the chart in literally no time. That's how powerful this is. Let's look at JSW Holdings, right? So let's look at JSW Holdings. Is also a very, very interesting name and interesting example to see. Look at this. Okay, very, very crazy, right? So I've got my previous high being broken over here, so I'll just write PH over here. That's the previous high. Displacement, narrow range consolidation before the break, high volume. Okay, done. Price comes back into this range, gives me a green candle close. Okay, done. I've also got a volume dry up. That's also done. Where's going to be my entry? My entry is going to be here. My stop loss is going to be here. My target could be 1 is to 2, 3, 4, 5, whatever. And then just look at this. Okay, so you will just enjoy this like anything. Just look at this and look at the move. 120% move in 25 days. How many of you are really enjoying this? 120% move in 25 days. Now, when the price broke another previous high, just look at this displacement. Now, the problem over here is that the volumes weren't really enough. So in this case, the volume confirmation didn't really happen. This is your narrow range consolidation. The price comes back into the order block, gives you a green candle closing right here. You can take a trade, maybe with the lower size because you did not have a volume confirmation. And then your target can again be above this high. The price comes here and then just look at this. Just look at this. The price again moved 81% in 49 days, right? That's the power of institutional order flow trading. You can do this in Angel One, another example over here. Previous high break with good volume, right? So this is what you will see. Previous high broken, good volume, body of the last red candle, wait for the price to come here. The price has come here, green candle closing, volume dry up, price comes here, your target is above this high, the price just continuously moves up, gives you a 31% move in 26 days, you're done. So simple, straightforward, clean charts, no indicator, no pattern, nothing doing over here. You are specifically focusing on those areas where institutional activity is going to be on the higher side. And you have like multiple other examples. I'll take up now a few examples on the short side so that you can understand how to use it on the short side as well. And I will start with Bank Nifty. So I'll go to a smaller time frame now. I'm going to go to a 15-minute time frame. Let's try to understand how this works. So very simple and straightforward right over here. So let me just redraw it. So you can there are multiple places where you would have probably gotten a trade over here. So I can show you multiple examples. But let's see if you can identify the ones which are good. Okay, so let's start with over here. Maybe I'll go to a 10-minute. Okay, I'll just go to a lower time frame. Let's go to a 10-minute time frame. Now, again, you have to see simple things. Your previous low is being broken. Your previous low is being broken with big candles. Now, whenever you are dealing in the index or commodities, don't look at the volume. I'll tell you why. These instruments are traded in derivatives, right? So there are multiple futures contracts, the current month, the month ahead of this. And then there is trading done in the spot charts. There are trading done in the futures, in the option segment. So the volume doesn't really play a big role over here, since stocks are something which are taken in delivery in the demat accounts. That's why the volume numbers matter. Over here, even if I remove volume, it will not really impact my trade idea at all. So what do I have to do? Body of the last green candle this time, not the red candle, the body of the last green candle. I am including the wick that is there. This is the displacement. I'll wait for the price to come here and give me an entry. So that's my OB minus or the order block negative. I get, so either I can enter here, which is like just a kiss over here, or I can enter over here. Let's assume I will enter over here. So I'll just adjust my trade a little bit. So that's my entry, that's my stop loss. The price comes here, swirls around for a decent period of decent period of time, and then gives me an entry and then just dumps like anything, right? So it consolidated for a while before giving really the big move. Now there are multiple ways to trade this. So some people will take an entry over here at this candle. Some people would want to take an entry after a confirmation, which is at this red candle. And in that case, your stop loss is here. Your target is below this low. And then just look at the move that you have got, right? And you can always see that how how interesting are the reactions that come in over here. And that's just crazy. It's a 1,000 point move in about 4 days. Now you have got another example, and I'll just show that also to you so that you can, clearly understand that. So you can see that when this move happened, so I am only considering this part of the equation, right? So the price went down, had a big gap down, and then the price recovered. In this scenario also, you have the body of the last green candle. This is your order block. Price comes into your order block, gives you a red candle closing. You've got your trade idea over here with a stop loss here, and your target could be a 1:2 or a 1:3, and then a very clean move, right? That's bank nifty for you. Right now over here, no trades at all, nothing doing over here. Now you can see another example over here. You can see that you know there is a break of structure over here. What's the body of the last red candle? That's the body of the last red candle. This entire thing is a consolidation, by the way. I can include this entire thing. Price taps in over here, and then just look at the move, right? That's another example for you. Now there is another example over here, previous high being broken. So this is a long side example, previous high being broken, body of the last red candle, price comes down, you take an entry. Just look at this, right? So that's again bank nifty for you. Now, can you show nifty? Okay, I'll show you nifty, not a problem. And see, there are days where there is no trade. So for example, on this day, my system didn't really give me any trade. On this day, no trade at all. So in Bank Nifty, no trade on these days, and that's fine with me, right? As a trader, you need to understand you'll not get trades every single day, right? You have to wait for the best of the best opportunities, right? So let me go to Nifty. Okay, let me go to Nifty and then I'll explain. So this is like a clean example. Let's go and understand this. So you can clearly see there are two places at which you are getting a trade opportunity. One is this, where you have seen a big displacement. The price comes here. Now, don't get confused that this is a green candle. Why are you considering this? Try to understand. The price actually gapped down. And then after the gap down, the price gave you a recovery. So this is the body of the last green candle. The price comes in here. That's your entry. That's your stop loss. And then just look at the move that the price gave, almost a 400 point fall in about 4 days, right? So that's one example. Now I'll give you another example in Nifty. I think this is a clean example. Let me give that to you. So you can see the previous high is being broken. This is the body of the last red candle, and then the price comes in here, gives you a tap in into the entry. So this is the candle at which I will enter. That's my stop loss, and my target could be anything. So my target could be a 1:2 or 1:3 at least. Price does nothing, 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 and then a big gap up, and then the price is sustaining over here. So another great example right here. Let's take up a few more examples on the short side, the places where I will find them. Let's try to see where exactly are we able to find them, and then we will take. So this is another example, very clean one. The previous low is being broken. So this is your previous low being broken. Where did it start breaking from? The body of the last green candle. The price comes here, literally invites you to go short. That's your stop. And 1:2, 1:3, whatever is your target. Clean moves, momentum moves, and this is on a 10-minute time frame. You can do it on a 5-minute, you can do it on a 1-minute time frame also, right? Now I'll show you silver, right? So silver, and I'll show it to you on the daily, because on the daily there was like a crazy setup in silver. So I'll just show that to you as well, and then you'll get like a decent idea, right? So the first thing is this little order block. So you've got your previous high being broken over here. This is the body of the last red candle. Price comes here. You get an entry. As soon as you create your entry over here, your stop losses are here and your targets will be above these highs, right? So you see that's your target, and then just see the way in which you're basically getting your targets to be achieved. easy trade over here. Then you can see another order block over here, another displacement, body of the last red candle, price comes here, gives you an entry here. Then just look at the one-sided move that silver gave. Then there is a bearish displacement over here, body of the last green candle, the price hasn't really come here. Price comes here, gives you an entry to go short on the daily, and then that's the area, and this could potentially be your target. Why will this be your target? Below every low there is liquidity, and then the just look at this, just look at this on how price liquidated, and just look at these big candles. It's almost a 14% down move in about 13 days. Yes, he had to stay stable a little bit. Now if you want to go look at silver on like a even smaller time frame, you can even look at that. Like this is a 15-minute time frame, right? So on a 15-minute time frame, you can see there is another OB. I'll just delete this. On this is a 15-minute smaller time frame, there are two trades that I can find, right? Number one is here on your screen. That's the break of your previous high, body of the last red candle before the big displacement, price comes here, you get an entry. Just look at this, boom, right? Then you see break of this previous low, right? That's your previous low. This entire region is your order block, right? So although if you want, you can just mark this one, but this entire region is your order block because of this narrow range consolidation. If you want, you can do this also, right? So the body of the last green candle, price comes here, gives you an entry, right? So that's your entry, that's your stop, and your target will be below this low, which is liquidity 1:3, 1:4. Oh my God, just look at that, right? Crazy, smooth AF, right? So give me a yes, give me a quick yes in the chat box if you've really enjoyed all the example that I've given you. Again, Nifty, Bank Nifty, Silver. You want to do it in Bitcoin, you can do it in Bitcoin also, right? So just open up Bitcoin, open up a 15-minute chart. I really like the 15-minute time frame. It's one of my favorite time frames to to be working with, because it's just much cleaner than anything else, right? So just look at this drop, right? So this is a clean example. So you break your previous low with a big displacement. You've got the body of the last green candle. Price comes in here, gives you a red candle closing. That's your short, that's your stop. And then where's going to be your target? Your targets are going to be below these areas of liquidity. And if you scroll down, you have this liquidity here as well, right? Just look at this, right? You take up your entry, and then these were your two targets. The price takes its own time, but then look at that. Look at that move, right? So much money to be made over here in this entire move, right? Very clean, very easy, and you just have to wait for the right setup. Now have a look at this, right? So this is another displacement, not the cleanest of the lot, but body of the last red candle, very big wide body candle. If you stick to your rules, you've got your entry here, your stops are here, and your targets are going to be above this high, right around this. That's your 1:1.7. If you want, you can aim for a bigger target, maybe above this high over here. And if you follow the rules, you would have gotten your target even more, right? Even more. If you would have held it for longer, that's the move. Although there's too much volatility in that, but the point is you can find all of those moves. So now, with that being done, I'll move back over to my presentation. Golden rules of the market done. How institutions operate the markets, that's also covered now, right? Price delivery is what I'd explained to you. Liquidity is also something that we've covered. I've explained this entire schematic also to you. I've explained market structure to you. Now these are very easy peasy examples for you. Break of the previous high, big volume, blah blah blah. Body of the last red candle, price comes, boom, right? So you don't really need to do anything. And now there are some screenshots that I want you to take before I go to my live market executions where all the learnings are hidden, right? So take a screenshot of this. This is like a schematic, which could be like a cheat sheet for you. So take a screenshot of this. Done. Perfect. Take a screenshot of this. This is your entry model one. Done. Take a screenshot of this. This is also perfect, right? All the screenshots are done. Now I will be moving over to case studies where I will explain how exactly I've taken all of those trades, Nifty, Bank Nifty, what's the PNL, all of that stuff. Quickly, I'll skim through those case studies so that you get an idea on how are they to be executed in real market conditions, right? So now let's get started with case studies, and you're going to learn a lot of things. So I'll just explain what is going to be the structure of case studies. So I'm going to show you a lot of case studies where you will understand how to use these strategies and how are these strategies actually executed in the live markets. And I'm going to be showing you executions also, the trade ideation also. Since there are a lot of case studies, I'm going to be going and skimming through them so that you just get an idea on the versatility of different assets on which this strategy can be applied: options, futures, commodities, index trading, intraday trading, swing trading, positional trading, all of that stuff, right? So this is an example. The first one is Nifty 50, and due to this image, you're unable to see the order block, but I'll just show you how exactly it works. So there was an order block right here in which the price tapped in, and as soon as the price tapped in, we took an entry. And as I had told you that above every high, there is a lot of liquidity, and that's exactly what our target was, just above this high. As you can see, the price just skimmed through it and then dumped back down, and that's exactly where we sold. So as soon as the price came here, this is exactly where the we sold and booked profits in this particular trade. And this is a Nifty 50 trade on a 5-minute time frame. Now moving on, this is another Nifty 50 trade where we took advantage of the consolidation, and we took this trade. And just understand that you need to get in before these big candles are actually created into the markets. That's the whole point of institutional trading. Coming the next one is Nifty 50 and Bank Nifty. Now this is a very, very big move that we captured. And understand that trading is not as simple or as direct it looks like, right? So we took our entries over here, and then the price went very near or very close to the target, I think only 7 or 8 points, and then it just blasted through the roof. And you can just see the big move that came in. I think the premiums almost doubled up. In Bank Nifty, it was a much simpler, straightforward kind of a move. But this is the power of institutional trading, and this is all done on a 5-minute time frame, right? Next up, you've got another Nifty 50 trade, and you can clearly see that we were taking advantage of the liquidations that were happening over here. So I'll just change the color. The liquidation that were happening over here, everyone was looking for shorts because of this big down move. But since you are an institutional trader, you understand how exactly things work, and we took advantage of that and captured this entire move, as you can see on your screen, right? This is again in Nifty puts. This is Tech Mahindra, and we again took advantage of Tech Mahindra entering into like an order block region. As soon as it tapped into this area, we took the trade, and you can see the move that came in. And this trade was taken in the future segment. Again, this is a 15-minute time frame. So if you can see this or not, I don't know. This is a 15-minute time frame on which I have executed. So a lot of people are asking what time frames at which you have to execute it. This works on every single time frame. My personal favorites are 5-minute, 15-minute, and the hourly. This is a short trade in the Nifty 50 index, and we took it the entire move we rode, and these are the executions of the same. You can have a look at that with the verified PNL. This is again a Bank Nifty trade that we took advantage of. You can see the body of the last red candle, the big move. This is in call options in Bank Nifty. This is Dalmia Bharat. This is a range break trade, and this is another strategy that we usually cover. Right now, you don't probably know about it, but this is like a simple range break strategy. But we use institutional footprints to identify whether this stock will actually move or not. This is Dalmia Bharat, taken in the month of May. This is Deepak Nitrite, again entering before those big candles and before the big move was happening. This was taken in call options. So the investment for this particular trade was about 22,000, and the gain was around 6,000 rupees per lot, which is like a 25 to 30% ROI on your investment. And that's taken in Deepak Nitrite. This is E2E Networks, which is a cash segment stock, and you can again see 35 to 40% ROI in a matter of like 7 or 8 days. And again, we were able to capture that move in the cash segment. This is another trade, JSW Holdings. We got a 79% move. Yes, 79% move in JSW Holdings in a matter of about 2.5 months, right? So that's again the power of how institutional trading and order block trading can really help you, even in swing trading and positional trading. This is another example of NACL Industry. It's a pesticide and agrochemical stock. And from March 2025, you can see over here from 12th March 2025, we captured like a 69.5% move in NACL Industries. Again, that's the power of getting in with the institutions. Cochin Shipyard, Garden Reach Shipbuilding, both of these defense stocks, we were able to capture 37%, 29%, and all, done very, very recently. These are all the trades that we gave out to our members.